Hi, good evening, and welcome to Orange County Real Estate Investors Association. I am appearing today as the logo of my company, UDirect, because I'm a little under the weather today. We have a fabulous meeting. I'm so excited that you're here to join us. So right now, we're just going to let people in the room and we'll get started at the top of the hour. So hang out and we'll get started at 5 o'clock. And so that's coming up in just a bit. Hey, everybody, thanks for joining OCREIA tonight. My name is Karen Hall, and I am the founder of OCREIA. We founded this in 2012 as a branch of National REIA, so Orange County Real Estate Investors Association. But ever since COVID, we've been doing our meetings online, which is really great because we can bring in the most amazing speakers like Lauren, who is speaking to us tonight. Lauren and I you to hear her speak. And so, Lauren, do you want to turn on your camera there?
Yes. I didn't really.
Awesome. There you are.
Oh. Hi, everyone. I'm Lauren. I'm
I,
with, yeah,
yeah, I tweaked my back, so I'm just not going to be, you just won't see my face.
no worries. No worries. Let me go ahead and
Yeah.
find my deck while I am doing that. Sorry, guys, bear with me. It for some reason won't let me share. Do I have capabilities to share?
You should. I've stopped sharing.
Okay,
So
so
there's, yeah, just
maybe
hit
I,
the big green
maybe I
button.
preemptively tried to share when you were still sharing and it didn't let me. Okay, let's see. There we go.
There we go.
Okay,
Beautiful.
awesome. Welcome, everybody. Karin, thanks so much for having me here. I My name is Lauren Wells, and tonight I am going to be talking about mortgage note investing. Probably some of you may have heard of it, some of you might not have. I do love questions, so if you have questions along the way, I'm actually going to keep the chat open, and if you want to drop them in there and I can answer them throughout, within the presentation I will, or I'll get to them at the end. But mortgage notes is probably not something most people have heard of. When I tell people what I do, they typically think, oh, you're in real estate, you do fix and flip, Airbnb, or you do long-term rentals. So I always love talking about mortgage notes. I think it's a great way to get started in real estate investing. And with that, let me talk you guys through what I'm going to cover tonight. So I actually want to talk a little bit about my backstory. So my name is Lauren. I am a co-founder at 70 Investments, but I didn't start there. I actually was probably sitting right where you are, attending every real estate investment club, networking, and trying to learn more about how I get involved in real estate. Where do I get started? What do I want to start with? And kind of taking it all in. I had a job in software sales. I'm actually based up in Santa Barbara, California. I went to university here, got my first job in software sales here. And it wasn't until I was actually volunteer coaching for a local high school water polo team with all the extra time I had before I had children, that I realized most of the parents who were at every game, every practice, every tournament were either business owners or invested in real estate. And so at that point, I knew I wanted to own my time and I wanted to invest somehow in real estate. I got started with some, traditional managing some long-term rentals. But what I've learned through in that process was I don't really love being a landlord. I don't love dealing with tenants, termites, and toilets, as they always say. So when I heard about mortgage note investing, it intrigued me because I liked the idea of becoming the bank. I liked the idea of not having to deal with a tenant, but rather a borrower with a set of terms and conditions on how they were going to repay their note and their mortgage. So it's a little bit about me, where I come from, and kind of how I got started in this. But let's dive into what you probably really want to know about mortgage notes. So the mortgage note industry is massive. If you think about it, everyone who's taken out any sort of first position mortgage, so like your traditional mortgage that when you're going to buy a home, second position, home equity line of credits, these are all falling within this mortgage note industry. And so this is a little bit dated. It's actually about 14 trillion at this point, with anywhere from 250 to 500 billion floating around in performing and non-performing debt. So, and that's only really what's reported by those credit bureaus. So there is a massive opportunity, and especially in this economic climate, we're actually seeing more and more banks starting to sell off assets as they're trying to be more liquid, which I will get to in a little bit. So, when you're looking at like kind of the competitive landscape, there's not a lot of people, there's a ton of inventory, and there's not a lot of people doing this at scale. A lot of people are investing in one or two. It's a great place to invest with self-directed IRA funds. So let me continue on here. So a little bit further back. So what is a note and a mortgage? So a note is really your promise to pay. It's a loan. It's an agreement between the borrower and the lender to repay your loan within a certain time frame with specific terms. So think of it as an IOU, and it's secured by your physical home in this case. So the mortgage is actually, people always get this confused. The mortgage is actually the legal document that secures the property to the note. So most people use these interchangeably when indeed they are two separate actual documents. So in case of any sort of default, the mortgage really gives that lender the right to foreclose or collect using that property as collateral. So what is mortgage note investing? So it is an alternative investment strategy secured by physical real estate. I think this is what initially drew me to this asset class. Is it's still real estate, it's still secured by something. Again, my focus is single family homes. The notes that I invest in are secured by single family homes. There are people who do commercial, retail. So when I'm speaking specifically to the single family space. But I was attracted to that because I had done, that long-term buy and hold strategy. And I thought, I like that it's physical property, but I don't like dealing with the tenants. So this kind of gave me the best of both worlds. I was still secured in the case of default, but I also didn't have to deal with the tenants. So no investors really are buying these loans from lenders, banks, credit unions, hedge funds, whole loan traders, other funds, smaller funds. So essentially they're purchasing these notes typically at a significant discount. This is kind of where that comes in. And they become a lender. They really assume the position of the bank as they hold the note. And then as the note holder, the lender, the investor has essentially purchased the right to the borrower's future payments and the term and the repayments according to that term. So when they buy these mortgages, they're not essentially changing, and nothing changes about it. So how I like to give an example of this is, I don't know if many of you have owned a home. If you have, you might have received a letter in the mail that said, hey, JP Morgan Chase is no longer your lender. We've actually sold your loan to Bank of America. Please send all payments now to, and here's the, remit payment to this bank account, this address. So that's essentially what buying notes are. Like your essentially loan is being sold from one lender to another lender. Loans are sold an average of 7 times. So this isn't a uncommon practice. It's something that is happening all the time. Like I just mentioned, you may have gotten that letter in the mail yourself. What I do is I'm one of the people buying those loans. So when you're looking at types of assets, you're really looking at performing and non-performing loans. And the reason this is important is 2 things. When it comes to risk profile, I think when you're looking to invest, you need to know, okay, 1, do I want to be active or passive? I initially got into this because I thought it was passive. All the books, all the gurus will tell you, oh, it's super passive. That's not necessarily the case whatsoever. It can be. And this is kind of where that difference come in, is between the 2 different classifications of notes. But as it's important to know, okay, do I want to be active or passive? It's also important to know what your risk threshold is. So performing notes are exactly kind of like what they sound like. It is when a borrower is meeting the repayment of their loan, paying on time per the terms of their agreement. These are actually typically purchased for anywhere to 60 to 90 cents on the dollar. So let's go back to that, you get a letter in the mail. If you had a $500,000 loan that you had taken out with JP Morgan, they might sell it for 400,000 to Bank of America. And I will get to why in a little bit. Non-performing, these are typically purchased at a greater discount. And the reason is they're exactly what they say. They are not meeting they're not repaying, they're behind 90 days or more. For example, in our portfolio, our average delinquency is actually 3 years, which shocks a lot of people. But it is not uncommon. And there's obvious the reason there for banks wanting to get those off their books. So this is how kind of note investing works. And I like to talk about note investing as really fixing and flipping mortgage notes, because everyone understands or has watched an HGTV show where they see, usually it's a husband and a wife, fix and flip a property. And so you're all probably familiar with that analogy. And so that's essentially what we do with mortgage notes. We're buying loans on single family homes at a discount to their unpaid balance. We then really have two main exit strategies. The first, and about 90%, I say, of what we do is negotiating the payment schedule with the borrower, generating cash flow from those payments, and then the exit. And this is what I love about notes. There's so many different, ways to negotiate with the borrower. And then two, the exit strategy, we can resell that note back on the secondary market for someone who wants a performing note. The borrower can refinance, pay off the loan, or the borrower sells the home. As you can imagine, during COVID, there was a ton of refinancing going on. So we purchased tons of non-performing debt. People were refinancing and paying off left and right, which was great. Inventory was a little bit harder to come by at a good price because everyone realized this was happening. So they wanted par for, a defaulted note. Now, about 10% of our portfolio will go through the lower exit strategy. And that's really what most people, I think of when they think of mortgage note investing. They think, oh, cool, if the borrower's not paying, I'm just going to foreclose and take back the property. So that's actually how I initially got into it, and realized very quickly that foreclosure is long, tedious, and costly. And while you can recuperate some of the costs that go into foreclosing, not all of them are, oh gosh, I can't think of the word right now. For some reason, it's not coming to me. But you can only collect so much. So taking ownership of the home typically happens because the borrower is one of those borrowers that says, no, I'm never going to pay. I haven't paid in 3 years. I'm not paying again. You'll have to kick me out of the home to make me do anything. That's, I'd say 2% I've done this over 500 times. That's about 2% of people, which I think is kind of a misconception people have. The main reasons are there was a death, family inherited the property, and this one shocks people. The borrower's loan has been sold so many times, they didn't know where to send payment. We contact them. We actually pick up the phone, which most banks do not. Call them and get them on the phone, send them a legal letter showing them where their lender, and they start remaking payments. Again, the percentage that go all the way through that foreclosure process is pretty nominal, at least in how we approach it, because it is much quicker. Typical foreclosure takes anywhere from 18 to 24 months. I know they say in Georgia, it takes 4. I've worked in Georgia. I've had assets in Georgia. Yes, the foreclosure process took 4, but it took me another 1.5 years to get paid by the court. So again, 18 to 24 months typically there, where we can negotiate a payment schedule with a borrower, generate cash flow, and flip that note onto the secondary market within 18 to 24 months. So not only are we generating cash flow while it's being seasoned for 12 of those months, we're also not putting more money into it. So the ROI is better. It's just a better exit strategy for us as a team and as a company. So risk mitigation and due diligence. When we someone asks, they don't understand what I mean by buying a loan. So essentially, banks are looking to balance their books. And I think I have a slide about why banks sell loans. But when a bank sells a loan, the terms aren't changing. basically they are doing what's called they're transferring the loan from say Bank of America to Chase or Bank of America to 70 Investments. They're transferring the rights to collect on that loan as a lender. Nothing changes as far as what the borrower's obligations are. So when we are looking to purchase assets, what we get is it's called a tape, which is really just a glorified Excel spreadsheet of loans. It will have the borrower, the property address, the P&I, how much they're in default, if they're in default. It will have any legal status, taxes owed, all of the information on a single line per note. So you can imagine you're getting a tape of 100 lines, and each line contains a different information about different notes. So from there, we kind of pick and choose lower down kind of by our buy box, what works for us. And we put in what's called an indicative bid. Now, this is where obviously, as with most real estate investing, money is made on the purchase. So this is where we put a lot of upfront work into. For example, I kind of compare this to buying a home in the way it's done. So we can give an indicative bid based off of our high level criteria being, is the LTV super low? Where is the property located? What is the borrower's credit history? What is the outstanding? Is it performing? Is it non-performing? Is it illegal at all? Because if it's illegal, is there a bankruptcy on it? So high level, we look at those, we assign an indicative bid, we get that back to the seller. The seller then can say, great, we accept, we reject, or we counter. At that point, once we come to an agreement on, an accepted bid, we essentially then have escrow or a due diligence period. And that period lasts anywhere from 4 to 6 weeks, kind of depending on how quickly things move. As long as you're continuing to move through the process, sellers are pretty amicable on, it's not like a hard cutoff. So the due diligence period is when we basically get eyes on the property to make sure it's valued correctly. We get BPOs on the property. We run it through legal in that specific state to make sure title is clean, that in fact it's a first position lien, not a third position lien. Make sure taxes are paid. And then we also look at prior servicing notes. And this is super important when evaluating an asset because it's important to see what are the odds of the borrower coming to the table? Are they a serial bankruptcy filer? Have they filed bankruptcy 6 times? Probably an asset we're going to pass on. But most of the time in the servicing notes, what you'll find is they lost their job or some life event happened. They go back to the bank, and I think I talked about this a little later, and the bank has zero flexibility in how to work with the borrower. So really it's evaluating the borrower as much and their situation as much as it is the property and the area. So we bid based on, and this is again something I really love about notes, is there's not one exit strategy. So you might have seen a lot of recently multifamily value add properties, and their exit strategy for a while was get something at 3%, value add, refinance, pay everyone off. Rates went up. That's actually not great right now for them. I love that in mortgage notes, you can really bid it off of several different exit strategies. You could make it reperforming and flip it. You can go through foreclosure. You can do a deed in lieu or a cash for keys. So you can do a quick flip, which means, say, for example, we bought a loan in Montana as part of a pool where we had to take down the entire pool. We don't do loans in Montana necessarily. We don't have attorneys there. We don't have vendors there. Just not a state we do business in. But we know who does, and they will buy it from us right after we have purchased it with this asset. And it's a quick flip. So really before purchasing, we have done thorough due diligence on every single asset, making sure it's secured and collectible. So mortgage notes as a passive option. You're probably looking at those performing notes. Now, within that, you can look at loans in first position or second position. You can probably guess first position, it's less risky. Second position, you really have to make sure that equity coverage is there. But they can be passive. I actually know quite a few people who have used self-directed IRAs or retirement funds to invest in mortgage notes, performing mortgage notes. So, hold on. Then you also have mortgage note funds. So those are really for people who want to be ultra passive. So they've looked into this, you're doing more due diligence on the sponsor. And I think with any kind of real estate investment, there's always the, do you want to do this on your own or do you want to go to the fund route? And they're both due diligence. They're just due diligence on different things. One, what I say when I started out and was looking at what to invest in, I found a few asset classes I liked. And then I found about 50 sponsors, literally in each asset class, that if you can find 50, and that you resonate with, that have done this, that have a track record, and then I interview them. Mortgage notes, what I like is it's that passive cash flow without the headache of tenants, termites, and toilets. You know, you have profitability in varying market conditions. So note prices in the marketplace, you know, they've really functioned in relation to supply and demand. So for example, during COVID, there was less supply, there was insane values being added to these homes, and you were able to take a person who hadn't a note from someone who hadn't paid in 2 years and sell it for a full price, because they knew that if they weren't paying and you went the foreclosure route, you got paid, or if you contacted them, they refinance and you get paid in full very quickly. Now we're looking at a different economic climate. There is inventory abundant. We are able to pick and choose kind of assets we want, which is great. I love to be able to cherry pick, and therefore pricing is a little bit better, much better. So it's also secured by physical collateral. Most of you are probably here because you're interested in investing in real estate. It is, in my opinion, one of the safer investments. Unlike stocks and bonds that are backed by very little collateral, have that high volatility, you know, a note is secured by physical real estate. And then, like I mentioned earlier, there's really numerous exit strategies aimed at making a profit. And I think this is where, you know, you can get creative. You can mitigate that risk by investing, again, in a ton of notes versus a single asset. So to kind of give you some color on this, I actually started investing in second position lanes. More risky, but I was working a tech job, my first tech job, and I was using my commissions to fund my real estate investment. I could get a second position note for $6,000. That is much more, I can pallet that much more than a $50,000 first time investment. So I was able to take $50,000, spread it amongst 10 notes, for example, and say, okay, now let me learn this. Let me learn it's okay. Like, I'm not putting all my eggs in one basket. And that really appealed to me as someone who was new to real estate investing and honestly didn't have a huge bank account at the time. So I want to talk, you know what, it looks like some of these slides got cut out. So I really do want to talk about a few reasons why banks would sell. That's probably the first question I get, is why would banks sell? So really kind of what we saw with Silicon Valley Bank is a good example. They're looking to be liquid. They're looking to balance their books. When it goes to non-performing, they want to get those off their books. And that's why they'll sell them at a discount. People think, well, why don't they just go the foreclosure route? You can go the foreclosure route. Why wouldn't they? Banks are very, very good at creating debt. That is what they're there for. They are very bad at managing it. So for them to manage something through 18 to 24 months of foreclosure, when they're not really set up to do that, it makes more sense for them to cut their losses, sell it at a discount, and in a month, turn around and take something that was making them nothing and re-originate a note, a new piece of paper with another borrower for 6%. They're also selling performing notes because a lot of performing notes were at 3% and interest rates are not any 3% or anywhere near it anymore. So they're losing money on those notes as well. So for them, sell them at a slight discount, take that money and go and originate new paper at 6%. So that is probably one of the most common questions I get asked. Another, and I'm sorry, I apologize, this slide deck is apparently not the one that it was supposed to be. But another reason or another thing that comes up or misconception is borrowers, how is your average delinquency? 3 years. Like, Doesn't that worry you? Why are the borrowers going to come to the table? Is this 2008? 2008 gets brought up a lot. Fair point. I think there's a big misconception that people wake up and just decide to stop paying their mortgage. For the most part, about, like I said, 90% of our portfolio, it is a death, divorce, job loss of some sort. And that typically catapults them down into like this snowball effect is what I call it. For example, we had a borrower who stopped paying because he had a health issue come up. You know, a year goes by, he's able to start making those mortgage payments again, goes to the bank says, that's great. You will apply your payments towards your past due and arrears. Like, this guy's never going to get caught up. You're 30K behind, you're making your monthly, you're never going to be current again. So at that point, the bank had eventually sold their loan. We picked it up, and we're able, because we're purchasing these loans at such a discount and we're not really held to the same kind of requirements as a bank, we're able to work with them, have that flexibility. So a borrower came to us, we did what's called a trial payment plan. And I do have some case studies I'll walk through here in a second. We did what's called a trial payment plan. And that means for 6 months, he made his monthly P&I. We applied it to current due. And then at the end of that 6 months, we modified the loan by extending the term. So adding those arrears to the end of the term, or we can do a trial payment plan. With him, we did a trial payment plan an extended payment plan for the arrears, where every quarter he was making a payment towards the arrears until he was caught up on top of his monthly payment. So not only is he reperforming and paying on time, but he's also catching up on his arrears in a way that is palatable, feasible for him. Like I always say, this isn't necessarily a charity, but I do believe that we have the ability to work with borrowers, and it's a more profitable solution for everyone. So why would we not do that? Someone asked a question. It sounds like you mostly invest in single family owner occupied properties. Any reason for that versus investing in larger multifamily loans? That's just my area of expertise and comfort. I do know some people who do multifamily. For me, I like that single family. I like owner occupied. I love that you picked up on that. I used to do non-owner occupied, and I learned very, very quickly that the non-owner occupied are typically the ones that drag you through legal for a million years. So one of our kind of prerequisites is that it is owner occupied. I think multifamily and commercial, as far as the notes space goes, there will be great opportunity there in the coming years, especially with everything going on. So if that's something that interests you, you can reach out to me. I can always connect you with someone. And then 2008. People ask how this is different. Why would the borrower be incentivized to work with you? So 2008 was really bad lending practices. People were underwater. Of course, they're going to walk away from their home. There was inventory abundant, and, it was a better option for them than trying to work out a loan they could never pay back. Now we're lacking inventory. Rental rates are through the roof, and their loan is probably at 3-4%. So maybe they haven't paid in a few years, but when they look around and see what their options are, most of the time they're going to choose to work with us in some sort of fashion. So that is another common question I get. Someone just asked, what is your experience with partial?
I have a question, Lauren.
Yeah. Yep.
Yeah, you're talking about your due diligence on these single family houses. And so you just kind of like went quickly through these various different steps, but I'm really curious, like you said, we check about the taxes, make sure the taxes are paid. So how often are you running into a situation where there are back taxes, tax liens, and how do you deal with that? I guess you just bring it current, but how do you factor that in when you're buying the note?
Yeah, so we're obviously checking for that up front before we've purchased the note, before we've onboarded it. But if, for example, we purchase notes and then down the line someone goes delinquent, we actually have a vendor we work with who monitors all the taxes on all of our loans and will tell us, okay, when things have been paid. And we don't automatically pay it right up front. We will contact the borrower and let them know, hey, your taxes are due. But there's, as you can imagine, and I'm sure you know, there's many steps before it goes to tax sale. So we're notified as this progresses closer to tax sale. And if it gets to that point, we can pay those taxes and will. But typically we're able to contact the borrower and, figure out what happened, why they haven't been paid, especially if it's someone who's performing. That would be a little odd that they'd be paying their mortgage, but not the taxes. So it's not something where we right away would pay them off. And then again, this is after we've acquired it. Before, if we find out that there is someone who, there are delinquent taxes, we might actually fade our bid. So if we find something, for example, like taxes are outstanding, it's a second position lien that they said was a first, or the property value was marked at $1 million, but it's actually 300,000. We will fade our bids on those assets and give a reason why. And typically, if there's valid reasons, then there's no problem with fading bids.
Yeah, the taxes that can really be a situation. And then you really touched on my question, when to make sure that you're taking care of it before it goes to tax sale. So thanks. That was great.
You know what? I just realized my slides were out of order. I did have the right one. Frequently asked questions and case studies. That's why. So asset class in this environment, really important. So I'm sure you might be hearing private credit a lot. I'm sure you see it all over the news. You probably see debt funds popping up everywhere. So really, this is considered private credit. And, inflation is going to lead to higher mortgage defaults. We are already seeing that. For example, inventory, like I touched on how big this market is, but just to kind of paint that picture, last January, I probably saw about 300, last Q1, excuse me. I saw in 2023, I probably saw about 300 million loans come across my desk to evaluate. Q2, it was about 300 million a month. By Q3 and Q4, it was about 300 million a week in assets open to be evaluated. So, it kind of starts as we saw credit card debt, we saw auto loan defaults, and now homes are starting to follow. So, again, and as rental rates go up, really borrowers are incentivized to stay in their homes and try to work out something with their lender. Another important thing is because most of these loans that are being sold aren't ones that were originated 2 years ago. And I think that's important to note for a variety of reasons. If you're looking at something that was originated 2-3 years ago, that value of that home is probably inflated. You might be worried about, values dropping and then your note not being able to be covered. But if you're looking at something that was originated in 2000 to 2010, not only do you have the COVID inflation, is what I call it, where or COVID values, where values skyrocketed, but you also have just natural valuation happening. So you're pretty buffered in for any kind of market adjustment when it comes to housing. Most of the LTV on our portfolio, my portfolio, is about 30%. So really low LTV, which is, again, something else I love about this. What motivates sellers? So banks want to get non-performing assets off their books. They can get better rates during high interest rate periods by originating new loans. Lenders on the secondary market. This is a question I get. Well, who buys your loans? Why do lenders on the secondary market sell? For example, it could be that their fund is closing. They're looking for more liquidity. They're looking to rebalance their portfolio. So maybe they're only focusing on performing or only focusing on first, whereas before they might have done a mix. Or it may not, like I mentioned, that Montana loan may not fit their buy box of a tranche that they had to acquire as a tranche. Top 4 reasons right here that people go into distressed, fall behind on their mortgage onto times of distress. Job loss, health, divorce, and death. And then I kind of want to show what this looks like. And again, I could probably pull up 50 different case studies that would show you different exit strategies and all looked a little bit different. So I kind of just picked 2. So this was purchased in July of 22 as a non-performing loan that was 10 years behind. The borrower is completely non-responsive. The prior lender could not foreclose because there was a title issue. We made sure the title issue was fixed, acquired the loan prior or after that, and filed foreclosure in July of the next year. The court actually required mediation, which resulted in working with the borrower and the state. The state actually contributed $50,000 towards the borrower's payments, and the borrower commenced making payments in January. So something that I actually didn't know that I found out within the last few years was the amount of money states and home housing assistance funds have to help borrowers in situations that were affected by COVID, that had a loan that was originated prior to COVID. So we've had multiple borrowers that we've done mediation with where half or the state has contributed funds. The borrower has made all their payments since then. We've received over $53,000 in payments with an additional $15K in costs. So we're looking to sell this loan later this year as it will be seasoned, meaning they'll have made payments for about 12 months consistently and get pegged back as a performing note. So if you look at the stats, when we purchased this, the total amount owed was $205,000. They were past due over $110,000. We acquired it for $80,000. The value of the home was $274,000. So we like to talk about LTV and ITV. LTV was super low because the, again, loan was 205 out of 274, but the ITV and the investment to value, the amount we put in that we would need to be repaid was only $80,000 into that value if we had gone all the way through foreclosure of that $274,000 asset. So just one story of how we worked out. And then this is an asset. So the prior lender really did, and this is something I'd say that shocks me, is when a lender does really nothing to communicate with the borrower. You know, doesn't send a demand letter, kind of just throws it in a drawer and sits on it, hopes it'll pay. It might be because they bought it as a tranche and instead of selling it, they just were like, I don't want to deal with this. So they never sent the demand letter. It took forever to send them their loss mitigation package. So we acquired it in May of 2023 for $100,000. You can see the total amount owed was $158,000, and they were past due another $23,000. And the value of the home was just under $400,000. So we acquired this in May of 2023. We, took action. Again, a lot of this is just about doing what prior servicers did not do and having a process to stay on top of it and follow it through. So the borrower, after we sent the demand letter, which most people open because it's from an attorney and it's not directly from us, the borrower offered $4K and $3K with a $1K extra monthly payment in August. We sent another demand letter in October due to lack of progress, and they agreed to sign a trial payment plan, which included a down payment of $3,000 plus increase the monthly payments by $1,000. So they signed that trial payment plan in December of that same year. So that's 7-8 months later since we acquired it, and the borrower made the down payment and monthly payments consistently. And then after the trial payment plan is over, so those are typically about 6 months. So in next month, May, we will recast the loan with a modification. So far we've received $7,000 to date on that, and we estimate we could resell it on the market for $140,000. And kind of want to open it up for questions and answers.
How do you get through the due diligence and analysis on that sheer volume of millions of notes coming across your desk? How do you prioritize that? Who does it?
Yeah, so obviously we weren't always looking at millions of dollars. Like when I started this, I would probably look at a tape of like 100. And so I have a team. We have a whole due diligence team, and we have models and bid calculator and checklists and processes and everything built out for due diligence. But when I was doing it on my own and looking at 100 assets, I had my buy box. I knew in the beginning I wanted it to be second position. I wanted there to be a ton of equity, especially in the second position. They needed to cover the first and the second, and I wanted a buffer. So I had a very specific buy box that I stuck to when I was getting started because I wanted to learn and kind of not only learn how to bid on assets, which is a whole kind of learning process, but also I wanted to have as many at bats as I could. So I had a very specific buy box to kind of get a few under my belt and go through those full cycle. So I think it's about knowing, you know, I invest all over. That's how I started. I invested throughout the US. I know some people who will only do California. I know some people who will only do Georgia. I know people who are super crazy will only do New York. No offense, love New York. The legal is there is really gnarly. So not so much not my game, but I think if you're able to say, okay, I want to look at only Ohio, and I want to look at first position notes where the property value is anywhere from 400,000 to 600,000, you can really knock off a lot. You can say, I don't want them to have any legal, or I'm okay if they're in foreclosure, but if they have a bankruptcy, no, thank you. I want the loan balance to be no more than 100,000. So you can really set your buy box as stringent as you want when you're getting started. And then also now, just because there are so many assets, it's easy to be uber particular. I like investing throughout the US. I think there's places people won't go because they're, you know, harder to work in. New York is one of them. That's where I draw the line. But for example, Pennsylvania and Ohio, a lot of people don't like to do business there, but there's opportunity and you get better discounts on assets because of that. So I think it's kind of knowing what your buy box is, what your risk level is, and kind of sticking to that at first.
I appreciate it, Lauren. What can you give us kind of the metrics on on 70E? You know, what kind of volume are you managing right now, and what are your investors getting, that type of stuff?
Karin, can I?
What's that?
Yeah, I can. So
Yeah, okay, sorry, I'm here. Yeah, I mean, go ahead. I mean, they asked. I mean, obviously
okay.
OCREIA isn't, the point isn't to sell anything, but I mean, it's obviously, you know, Lauren is a co-founder of this company and she's got a lot of rich information about that. I'd be curious to hear this again too. So go ahead.
Yeah, I
Okay,
just want to be
sorry.
I know it's okay. I just want to be respectful.
It's all good.
Yeah, okay. So essentially we have a mortgage note fund. Have two different offerings that have done over 500 deals within them. Right now, we have liquidated a lot in order to redeploy, meaning a lot of our loans have gone full cycle. So right now we have just under 100 loans, but have a lot of capital to redeploy into assets. We're looked at as an income fund. So investors are getting income. That's not a growth option. So when you look at the different kind of investments, you can go income growth or tax. Everyone loves tax. Ours is an income fund paying anywhere from 9 to 11% depending on investment amount. So it's a fixed note or a fixed rate depending on investment amount. So it's not fluctuating over month to month. And our minimum investment is 5,000. For our Reg A offering, we went the Regulation A+ route. If you're not familiar with that, it essentially allows a fund to be stamped and approved and qualified by the SEC and raise funds from both accredited and non-accredited investors. So that's why the minimum is so low. It's something I'm uber passionate about because not everyone has 50 to 100 to invest, and nor did I want to start out with 50 or 100 on my first investment either. So it's something both Chris and I are passionate about. No one does a Reg A unless you're passionate about it because the SEC is not super fun to work with all the time. So yeah, we invest in non-performing and performing notes throughout the US. And we really stick to our model. We don't veer out of it, chase shiny objects. We fix and flip mortgage notes that are secured by single family homes throughout the US with a low LTV and an awesome team. So
is this similar? And then I'll shut up and go on mute here. But I'm kind of new to this space, and So percent.com and yieldstreet.com, are you familiar with those? And is that similar type of product?
I'm familiar with Yield Street. I'm not familiar with Percent. Yes and no. So they made their money off of the origination of the loan and would like sell it as a one-off. Ours is a fund. We don't make money off of, so like essentially, and I might be wrong on this, there's Peer Street and Yield Street, and I do get them confused. I will be honest about that. But some of the ones out there function a little bit differently in that they will help originate a loan for an investor, and then the investor essentially owns that loan and the payments. But if anything goes wrong, there's really nothing holding that company from doing anything. Their money is made on the points. Our money is made on the backside of investors. So we get upside after investors are paid. So in that capital stack, we don't take on additional leverage. Investors are first paid. Any gravy, you could call it, goes to 70. So we're not originating any notes on a one-on-one basis. We're saying, hey, you are investing in a pool of mortgages and you're giving us capital to go buy more, and we are going to pay you a percent for giving us that capital to deploy.
Okay, that's very helpful. Thanks, Lauren.
Yeah. Yeah. I mean, aside from 70, obviously it's my baby, but I'm again passionate about investing in funds, due diligence on sponsors and all of that. So if anyone has questions about that outside of mortgages, just, hey, I'm new to investing, how do I evaluate funds or, assets? Like, I'm happy to talk as well. So.
Lauren, we have someone here asking if you would share your deck. I'll remind everybody that we are recording tonight, and I'll share the recording. But if you want to share your deck with me, then I will forward it on to anyone who wants it. I'll put my email here. And I think there are a couple of questions here in the chat.
I
Quick
have
question. Go ahead.
Oh, sorry, Douglas, thank you for your question because it kind of feeds into mine too, and but a different angle. So I'm a realtor. I've done promissory notes or private notes. I'm not sure how much of a difference there. Right. So just letting someone borrow money and then yeah, right. So I had a second position. But I think like me, what I want to do is I've been looking for people to operate with in this capacity where it's local. I'm looking to buy locally. So I'm looking at situations like the economy, the way I see it. We're gonna be I put it in the text thread there. Like I think we're gonna be like in the Japan type of thing where it's gonna be a long, protracted 2008, but much slower with the same kind of level of distress over a long period of time. So maybe you and I can talk, or you can address what you think about that. But I'm actively looking for properties where they're willing to sell part of their equity and want to maybe stay in there and they live in ADU. I have my guys that come in retrofit a 600 square foot bonus room that's part of that property, or build another ADU and they live there, retain the loan, goes against contrary to what you want, but get you involved in the conversation and give them many options. What do you think of that approach?
So would you then you would put the ADU, they would stay there, and you would rent out the ADU that you put there? Is that what I'm understanding?
So they would like live in the property.
Yeah.
Fixed, like a fixed rent,
Yep.
but retain their 3% loan.
Yeah.
And now we become the equity owners of the 4-bedroom, 2-bath house and rent that out for a premium.
Got it.
So I'm more about buy and hold, but some people want to have that option. So you want to give people all their options. So how would do you get to that level of conversation with homeowners and borrowers?
No, not really. I don't think we've ever had that level of conversation. Yeah, well, sometimes we'll do like a cash for keys and rent it back, but that's still different. That's like we get full ownership. They're just essentially getting to stay there.
But what if you were to be able to generate a referral fee off of the fact that they wanted to do something different, and then I provided that solution?
I mean, in California, we don't do much in California for a lot of reasons.
Well, but I would be generating the property conversation.
Yeah.
So,
yeah, we can talk offline about it.
Okay, cool.
Speaking of that, Lauren, while we still have some time, why don't you go ahead and put your contact info in the chat so that everybody can get a hold of you, because you probably have a slide on that, but just go ahead and drop it in if you don't mind.
Yeah, it's Lauren at 7einvestments.com. That is my direct email. 7einvestments.com is our website. And I'm also all over LinkedIn, or I try to be. It's hard to keep up these days.
Lauren, what kind of a default rate or bad debt, or I don't know what you call it, what does that look like?
Like how many deals have gone bad?
Yeah.
Yeah, so we've only lost money on 3 of our assets in this specific fund. And I'm saying by loss, like we've lost $8,000, not a full loss. And that I think is unique, but it's also because we're very much tracking our assets. We do everything in-house. We don't outsource anything. So we're looking at our assets. We're putting specific benchmarks they need to hit in the process. So if we sent a demand letter, we know, okay, 30 days from now, 15 days from now, we can send that, we can start the next step. Have they responded? Have they not? Have they gotten us their financial packet back? We set benchmarks. If assets aren't hitting those benchmarks, we will liquidate them prior to, like, we won't try to hold on and like make it work. So we're constantly evaluating our portfolio, which I think helps when it comes to, I know what you're saying. I get asked default rates. I'm like, a lot. I'm like, well, half of them are in default. So, but I know that's not your question. Yeah.
No, that's good. That makes sense.
Yeah.
And then since nobody else is asking here, I'm gonna ask another one. So if we have a big crash and interest rates keep going up, let's just say they go to 10, 15, 20% like back in the 70s, is that good for you? Do you have the capacity to be able to, you might have a lot of loan opportunities come across your desk, but what does that do to your current portfolio?
Yeah. So what's interesting is we're bidding on specific for a yield. So like if we see an asset that we want a 12% yield, say, we're looking at an asset that was written at 6%, we'll need a 50% discount. If it was written at 3%, then we're going to need a 75% discount to make those numbers work. So it's kind of like we're interest rate agnostic, direct impact when it comes to like how our portfolio would be affected, because we're bidding based, we're using the interest rate as an indicator in our bid. I am getting some questions. In retrospect, what would you have done differently if you were starting out? In this specific asset class, nothing. I feel like what I did was I found a mentor actually who lived in Long Island, and he helped train me on seconds, taught me how to bid. I basically worked for free for him, helping analyze tapes and learn the process of seconds. I then kind of, again, I'm big into networking. I love these kind of groups, meeting people, learning from people. So I don't think I would have done anything differently. I think, yeah, I don't think I would have done anything differently, which I can't say about many things, honestly. So I don't have any regrets with that. What is the minimum hold period on our fund? It's either 3 or 4 years, depending on which fund. Are the proceeds to the investors received income or dividends? So at the end of the year, it's a 1099 dividend, which is unique because you're not being taxed as ordinary income. They are qualified dividends. They're considered long-term capital gains, which is, so we're not a tax play, but I always like to say, like, there's a tax alpha, a tax bonus. Let me see if there's, let me see if there's any other questions. My contact info is lauren@70investments.com. I think I have another slide with that on here. There you go. I even put my phone number. That is wild.
Are you up in the Bay Area then?
No, I'm actually in Santa Barbara, California.
Oh yeah, you said that earlier. Okay.
Yeah. But we, are all over.
And you
What
guys
about,
are all over social media too.
We're all over social media too. We have some Gen Z marketing people that are good.
current deals where, okay, well, first of all, two-part question. Do you do wholesaling? Will you sell a property to an investor that's investing?
Yeah. If we take it back, we don't typically hold the property. We actually have an REO team that cleans it, guts it, and sells it as quick as possible. So we don't do any kind of like deals back to our investors.
That's probably smart. Okay.
Yeah.
And then where do you, however, it'd be good to have the inside scoop on where properties are coming up for sale. Is that possible to understand? to be a buyer?
Like if not in the notes capacity, just like
No, at the end.
in general,
At
like
the end,
off
you said,
market.
yeah, because you're handing it off to somebody, right? If they're, well,
Yeah.
did I correctly?
Yeah, I get what you're saying, but we don't, I mean, I'm not pulling inventory. Again, we're pretty focused on the note specific space, which is why we don't hold on to properties. Like we're like, okay, great. REO company comes in,
Okay.
bare minimum cleans it out and sells it.
Okay, then next question that relates to just kind of, I have interest in investing with something like this for sure,
Yeah.
but it's for a different end. And that's understanding what's going on in a particular market. So what states are you seeing the most activity in right now for,
For this
meaning
space.
distress? Yeah.
Oh yeah. I mean, where we are, we're in, what are we in? 29 states. A majority of those are in the southwest, or sorry, southeast, south, and northeast.
Florida and Idaho, by any chance?
Florida, Idaho, Ohio, Idaho, not as much. Ohio, Pennsylvania, Georgia, South Carolina, Florida.
Okay.
Michigan. Yeah.
Okay.
I think Ohio has the most amount of assets for us.
Okay.
Yeah.
You see this kind of business, like your business, going out of country also?
No.
Okay.
No.
It's so much easier to buy property out of country. Like it's like so much easier, but yeah, you don't, there are notes. The notes aren't there to buy.
Nationally, and yeah, we've actually just started working with a lot of financial advisors and RIAs, which has been super fun. So, but a lot of self-directed custodians. I mean, I have a self-directed account. I mean, I feel like there's not enough education around self-directed accounts. Actually, we're having Karin on our webinar to talk about it because I feel like it's something that everyone should have. Yeah, I'm really excited about that. If you want to attend that and hear her talk all about self-directed IRAs, definitely join us. She put her link there. I don't know if it's on her website, but yes, we're doing that next week, I believe, the 17th.
Right, the 17th.
Yes, and a lot of people use self-directed IRAs because for the fund, for investing on their own. It's a great way, I mean, again, if you have 5,000-10,000 sitting in a self-directed IRA, that's an easy invest to make, whether it's your own private note or a mortgage note or a fund. We have a lot of people who do that.
Self-directed IRAs are a miracle.
Yeah.
You can do crowdfunding and Bitcoin and gold and everything.
Yeah, I literally probably write about it at least once a week because as someone who, again, worked in that corporate tech world and I was surrounded by a ton of really smart people that are now, I'm like, how do you not know what a self-directed IRA is? No one talks about, even advisors that I work with are like, yeah, with Schwab. I'm like, no. So
well, that's because they get it. That's because they get a cut of every mutual fund and ETF they sell. That's why.
So yeah, it's really it's another thing I'm passionate about, just education in general. Oh, and awesome, Karin dropped the link to the webinar next week in the chat if anyone wants to join. Again, we won't talk, it's not really us talking about 7E. We'll talk about who we are a little in the beginning, Chris and I, but really it's Karin talking about self-directed IRAs, how they can work, how they function, who it's for, rules around them, and yeah, just sharing that wealth of knowledge. How is the money I invest in a fund secure? That's a great question. Depends on the fund, depends on what they're investing in, and depends, more importantly, especially now more than ever, what position you're in the capital stack. So if you don't know much about the capital stack, I'll speak to it from kind of high level terms.
Can I jump in there, Lauren? Because okay, specifically, I wanted to know about if I'm going to create a second, and someone else comes in and creates a third after me, but maybe it's a bigger number. There's a lot of that. Like, maybe talk a little bit about that if you don't mind in your answer.
So it doesn't, dollar amount isn't relevant. It's really how much, or it's really when it was originated.
Yeah. Okay.
So first is typically your first mortgage is like what most people take out a mortgage. Then people will say, oh, I want to redo the bathroom. So they'll take out a second or a HELOC. That'll be second position. it's important. This kind of ties into capital stack because it's the order in which you get repaid. So questions I like to ask from due diligence perspective as an investor is, okay, do you take on any leverage? So are you raising capital to then go to the bank and say I need a loan? And so you're leveraging investors' funds, which isn't necessarily a bad thing, but it's something to be cautious of in this economic climate. And then where am I in the capital stack? So what that means is if everything goes wrong and you have, if the person you invested with, if the fund you invested with has leverage, and then they have another like preferred fund, you might be third in the capital stack. So what you're seeing now is a lot of people are creating debt funds. And those debt funds are typically kind of in conjunction with other funds. Like they might have had another fund that isn't doing so well, so they're using a debt fund to raise capital for that fund. But what happens is these people who first invested with the sponsor get pushed down the capital stack, or I guess it's up the capital stack, into a less secure position. You're getting paid after, not just the bank gets their loan, but you're getting paid after this debt fund gets paid. So you just want to make sure, like, the question to ask is, where am I in the capital stack? Or if things go to hell in a handbasket, who gets paid first? Do you have any other funds? Do you take on any additional leverage? Those are all questions that I would definitely ask if I was looking to invest with a sponsor. And then another question I would ask, and this has nothing to do with mortgage notes, but again, this is something I really want people to, know who they're investing with, is do you have a track record verification report? So a lot of people can put whatever they want on their website. You can put your track record, you can put any numbers, and I by no means think people are out to like lie, but a track record verification report myself as an investor, I found out a few years ago I could ask for, and it's essentially a third-party report done by there's a few big companies that do them. Karn, KPMG does them depending on what state the fund is originated in or held in, and the Spalding Group. They'll do these reports where essentially they're auditing past funds that this sponsor has done. And they'll say, okay, how did you calculate these? They'll look at the bank statements, they'll look at the returns, they'll make sure basically that it's kosher, calculated correctly, and then they'll provide an opinion letter saying, hey, these are the funds, this was the net return, this is how it was calculated, we agree or we disagree. So I think that's a cool third party kind of verification when someone says, yeah, I've done this 5 times.
That's such great information, Lauren. And we're heading at the top of the hour. So is there anything you want to say in conclusion?
No, I love meeting with people. And I always love to give back and have collaborative conversations. So if you can find me on LinkedIn or email me and you want to just, I don't know, talk about due diligence on sponsors, due diligence on notes, the fund, whatever it is, I'm happy to connect and or if you're looking for a specific asset class, I'm happy, or a fund if you really like multifamily or you really like storage units and you're looking to invest passively in that, I'm also happy to share some quality sponsors in those arenas as well. So thank you guys so much for your time. And yeah, reach out if you have any questions.
Yeah, we'll see you on the 17th.
I'll see you on the 17th. And Cindy, I have seen your comments come through a few times. If you want to meet up, you're in Thousand Oaks, I'm in Santa Barbara, I would be happy to meet up somewhere in the middle. So
that's
yeah,
awesome.
I am so excited. I'm going to call you.
There you go.
So,
all right.
thank you.
All right, guys.
Yeah.
Everybody have a
Lauren.
wonderful evening. Thanks again, Lauren. This is wonderful.
Thank you.
Really appreciate
Yeah.
it.
Good stuff.
Thank
Awesome.
you.
Thank
Have
you.
a good one. Bye, guys.
Bye.
Bye-bye.